Hey everyone, welcome to this explainer. Today, we're diving into a genuinely brilliant piece of quantitative finance research titled Filtering Credit Risk with Stochastic Discontinuities by Felix B. Tambin Donfak. If you follow credit markets at all, you already know the core challenge we're facing. How exactly do we model credit risk when scheduled corporate announcements, like your quarterly earnings calls or regulatory filings, trigger massive sudden market shocks? We all know these dates are coming, yet the exact fallout? That's a total mystery until the clock strikes and the data drops.
So here's the million-dollar question, literally. Why do credit markets so frequently panic or experience these massive spread widenings on dates we have literally had circled on our calendars for months? The hard truth is that traditional finance models are fundamentally ill-equipped to handle scheduled events. They either treat information as a smooth, continuous drip, or they treat market shocks as total surprises that fall entirely out of the blue. But real life just doesn't work that way.
Here's our roadmap for this explainer. We're going to hit the credit risk blind spot, break down the anatomy of a scheduled jump, look at the math of market beliefs, dive into real-world spread dynamics, figure out how to hedge the unhedgeable, and wrap up with the new standard this research sets. Let's get right into it. All right, part 1, the credit risk blind spot, and where legacy models fall short. Think about the models portfolio managers have been relying on for decades. They've got some pretty deep flaws here. On one hand, you've got classical diffusion models. They assume asset dynamics are perfectly smooth, that information just sort of drips in gradually. But come on, earnings don't just drip. On the other hand, you've got inaccessible jump models. Think classic Poisson jump diffusion. Sure, they allow for sudden shocks, but they assume the timing of those shocks is totally random and unpredictable, just out-of-the-blue events. Both of these legacy approaches completely fail to account for the reality of our markets. Dates we absolutely know are coming, but with actual informational content we just can't see yet.
Moving on to part 2, anatomy of a scheduled jump.
So the author introduces this phenomenal concept called stochastic discontinuities. Basically, these are sudden, discrete adjustments in an asset's value that happen on completely predictable, publicly scheduled dates. But, and here's the kicker, the informational content itself is completely random. To actually solve the mathematical nightmare this creates, the paper brings in some heavy machinery, the Kushner-Stratonovich equation. It's a specialized nonlinear filtering framework designed perfectly to handle these predictable yet highly volatile calendar events.
It's best to think of this 3-step process kind of like a weather forecast for a hurricane. Step 1. Between known dates, your asset evolves continuously. You know exactly when the storm is projected to make landfall. Step 2. The date arrives and boom, you get a sudden, discrete Bayesian update. The storm hits, and only right then do you actually find out if it's a mild breeze or a devastating Category 5 monster. Step 3. Based on that sudden reality check, there is an immediate reevaluation of the firm's default risk. Which brings us to part 3, the math of market beliefs.
Now, you absolutely have to see the data visualizations from this study to grasp how this Bayesian updating works in practice. We're looking at 3 panels here, tracking asset value on the vertical axis against time on the horizontal axis. The top panel, that's your baseline model. No jumps, just a smooth, continuous filter, that blue line, trying to guess the firm's true asset value. Notice how it barely even flinches on scheduled dates? But then, look at the middle panel. This is our extended model with stochastic discontinuities. See those wide pink bands? That is the model screaming uncertainty. As we get closer to a scheduled announcement, right at the 0.25-year mark, the model is highly uncertain. But the exact microsecond that disclosure drops, those pink bands collapse sharply. The uncertainty is instantly resolved through a discrete Bayesian update. Now focus on that bottom panel tracking market sentiment. The author introduces what's called a sentiment multiplier. If the cumulative observation history has been poor, meaning, the market is already highly pessimistic, this model mathematically amplifies the downward shock of bad news. If you glance back up at those early disclosures in the middle panel, the drops are absolutely brutal. The model correctly compounds the bad news because the informational environment was already toxic to begin with. The legacy models totally gloss over this dynamic.
All right, part 4, real-world spread dynamics.
Let's see how this math translates into the visceral, real-world asset valuations hitting trading desks right now. This graphic is just a masterpiece of quantitative visualization. It breaks down exactly how a single scheduled event fractures asset pricing. We're looking at 4 quadrants, all tracking the exact same continuous diffusion path over a 2-year timeline on the x-axis, but we're subjecting them to different jump risks. Let's really break down what happens when you introduce the reality of a scheduled shock. Okay, in panel A, check out the red dotted line. It shows the asset value absolutely plummeting under negative sentiment jump risk, right at the 0.25-year mark. Compare that to the blue baseline model, which barely reacts at all. Now, shift over to panel B. Because investors are anticipating these future shocks, the equity value, again, the red line, is persistently discounted well before the announcement even happens. Moving down to panel C, this discounting causes the perceived leverage of the firm to violently spike. But the most striking result by far is in panel D. Look at the one-year credit spread. It doesn't just wiggle. That red dotted line exhibits a massive upward shift, sitting comfortably above 2,200 basis points under negative sentiment, compared to the blue baseline, which rests far, far below that. The market is aggressively pricing in the reality of scheduled shocks long before the actual calendar date arrives.
This takes us to part 5, hedging the unhedgeable. So the obvious question is, how on earth do portfolio managers protect themselves against this? How do you hedge when you don't actually know the true value of the firm, but you know a massive shock is imminent? The author tackles this using local risk minimizing, or LRM, hedging under incomplete information. I want to draw your eyes straight to panel C. Do you see that massive shaded orange area? Tracking time on the x-axis against the hedge ratio on the y-axis, that orange gap visualizes the exact quantifiable cost of ignoring predictable jump risk in a hedging strategy. The blue line is the naive baseline, and the red line is our extended model accounting for jumps. That gap between them, that is pure unhedged exposure. Let's decode the rest of these panels. Panel A shows what we call the incomplete info discount. Because the true asset value is unobservable, the optimal hedge ratio is systematically lower than if you had full transparency. You just can't trust the data enough to fully commit. Over in panel B, we track the unhedgeable residual. Since the market is incomplete, dynamic trading simply cannot eliminate all the risk from scheduled jumps. You literally have to eat some of that variance. Finally, panel D shows that as negative sentiment amplifies, the optimal hedge ratio actually drops even further, simply because equity prices become hypersensitive to disclosure shocks.
And finally, part 6, the new standard.
Let's look at exactly how sensitive this entire system is to our market sentiment multiplier, because this really establishes a completely new standard for credit risk. Here we see a chain reaction across 4 vital risk metrics. Across all 4 charts, the x-axis tracks that bad news amplification parameter, beta, from 0 to 1. In panel A, looking at the y-axis measuring basis points, as beta rises, the credit spread just skyrockets in a convex curve from around 31,000 to over 46,000 basis points. Panel B shows default probabilities on the y-axis, saturating near 100%. Panel C shows equity value plummeting in an almost linear fashion. And panel D confirms that as amplification increases, continuous defaults practically vanish. Jump-induced barrier crossings completely dominate the firm's risk profile.
Now, the data in this table reveals a truly fascinating paradox. Look at the column for filter RMSE. That's basically the error rate of our model's guesswork. As the amplification factor goes from 0 up to 1, the spread explodes. Equity is destroyed, and the jump risk share nears 90%. Yet, our filter RMSE actually drops from 6.2 down to 3.8. I mean, how does that make sense? Well, it improves because these violent shocks are highly informative. A massive drop forces the Bayesian filter to instantly snap back to reality, clearing out all the accumulated noise from the continuous diffusion. The worse the shock, the more accurate the market's read actually becomes. Which brings us to the core takeaway of this incredible paper. Sticking to legacy models means you are literally flying blind into days you already have marked in red ink on your calendar. You just can't pretend anymore that scheduled corporate events are either continuous strips of data or totally random acts of God. They are scheduled stochastic discontinuities, and they absolutely dictate the survival of highly leveraged firms. So, I want to leave you with this final, vital question to inspire a deeper look into your own quant models. Is your portfolio priced for a fantasy of continuous time, or is it priced for the brutal reality of scheduled shocks? Definitely something to think about before the next earnings season hits. Thanks for joining me on this explainer, and we'll see you next time.